Hey, it's the anonymous investor here showing you my portfolio in complete transparency, everything except my face. So today I'm actually going to talk about a video that I just saw with Meet Kevin on why Tesla stock is cheap, and it says Tesla to 6,000. Now, Kevin is someone who I respect in the industry as being a quantitative, strategic, and kind of economic mindseted investor, someone that really is an opportunity investor. He takes a lot of action, he's really active, but he has the ability to consume a lot of content, to learn a lot, and to hopefully make good decisions. His strongest conviction stock, meaning the thing he believes the most in, is Tesla. It makes up 47% of his portfolio. For me, I think I have around 20% or so of Tesla. Right now, we can see 540 shares of Tesla in this account. And so the market value of 365,000. I also have a Robinhood account of a couple hundred more shares, so we'll call it a cool $500,000 in Tesla. I don't have quite as much of a percent allocation in my overall portfolio as Kevin does. Kevin is fully committed, and I believe in Tesla. I believe in Elon. I believe in the future of electric vehicles. I believe in sustainable energy. I believe in their solar business. I believe in their full self-driving. I believe in their potential to have an amazing insurance company because they have so much data. Really, in the end, the companies that have software are the companies that are going to beat the other companies. So if there's a company that an industry and a new company comes in that has some sort of software or technology, guess what? That software technology will eventually overthrow that business. So you have Blockbuster, for example. Guess what? Blockbuster didn't technologically advance quick enough, and boom, you have Netflix. Industries need to have the advancements, and the advancements are going to be in technology. So I'm a big believer in Tesla, and what I wanted to kind of go over here is his video does a great job of breaking down the data. So here he has his bull thesis of what he thinks the company will do. And when you are analyzing a company, it's important to have your expectations and your predictions in your mind and try to be clear with them. So here he does a great job of really breaking down the numbers, and I'm going to get to a second why you don't need to be this crazy about numbers to be able to invest in an intelligent way. So here are his ramp details of how quickly he thinks the cars can get delivered, and delivered essentially means produced and sold. Now, these are usually two different things, right? People can produce a product and then they have to go out and sell it. The thing with Tesla, right now, the limiting factor in how many deliveries they have, how many sales they have, is actually their manufacturing limits, and that they're not building these cars fast enough. It's obviously an amazing problem to have. And here's a ramp that Kevin believes as kind of a bull cases, and it is jumping quick. It's ramping up fast here with going to 14 million by 2029, ramping up. You can see here almost doubling essentially. It slows down the rate of ramp, which is actually something that is probably likely here. Factories that they're building, they're going to have some pretty amazing, I think about 1 million vehicles produced per factory in the Giga Berlin and Austin and Fremont and Shanghai at the full capacity. And the efficiency is always increasing. So the next number to look at, besides just how many vehicles they're selling, is you want to know how much money are they making per vehicle. So here Kevin puts it at $42,000, including the value of full self-driving. Okay, so as Tesla has increased the products that they've been selling, they've actually been lowering their revenue per vehicle because they're selling less Model X's and S's and more Model 3s and Ys, which start at something like 37,000. So as Tesla continues to scale, their prices are going to go down. So there's no way at the end of 2030 that their Teslas are going to not be selling for, I would say, 30,000 and maybe less. That is Elon's goal, is he wants to sell Teslas for less and less money to really accelerate the transition to sustainable energy, which is Tesla's goal. Is this number too high, this revenue per vehicle? Maybe, but it includes full self-driving here. So when you're analyzing stuff, you can either do two things. You can try to separate every single item, or you can add the value of all the items into each product sold. And so this is a great way to try to keep things clean. He puts it at 42,000 per vehicle. So Toyota sells something like 10 million cars a year. And can Tesla get to 16 million cars a year if Toyota's at 10 million? Maybe. There's at least the market for it if they can get prices down.
Very bullish. And remember, this is the bull thesis, so we're going to go to the more like nuanced theses in just a moment and kind of see what Tesla's projections might be as well.
So it's important to understand that this is his bull thesis, like kind of what he expects best case scenario or close to that. And there's all these numbers from sales. Tesla is really unique because you don't just get a car company with Tesla. You get an insurance company. You get an energy company. You get a software company. You also get a service company. The deal with dealerships traditionally has been, hey, I'll sell your cars, but then when things break, you got to come to me. And Tesla's totally cut out the dealership aspect. But they can grow each of these businesses, and it's amazing how they have more and more businesses coming. There's a couple that weren't even mentioned in this video, but looking at all these numbers, realize that these can be fully, completely off. And when you're coming up with numbers, analysts are going to come up with their own numbers. They'll probably do a better job than you in terms of the numbers. So I don't think you should try to compete with analysts in terms of the numbers and looking at the data. Instead, I'm going to mention what I think you should compete with. Now, as you look at all the numbers, how do you actually get to the value of the stock? What should the stock be priced at? And right now, the PE ratio is going to be the biggest thing that you need to consider. Now, the PE ratio is this formula, okay? It's the price per share. So when they say, hey, Tesla stock is at $700, that's the 700 number would go there, divided by the earnings per share, how much money is actually generated or profited from each share of stock. That's the PE ratio. So people like Warren Buffett or value investors, they will have a low PE ratio in terms of the companies that they're investing in. That's because the earnings per share is higher. Those companies are profiting much more per share, which lowers the actual PE ratio. So a company that has a high PE ratio is a company that is saying, hey, look, we're not making a crazy amount of money now, but investors realize that we could be making a crazy amount of money in the future, and so our share price is going to be much higher than our earnings per share. And so you can get PE ratios going from, let's say, 5.0 for American Airlines, which is like, hey, I think we know where American Airlines is kind of going overall, right? Not super exciting, to a company that has a PE ratio of 73.9 like Amazon. To give you an idea of a company somewhere in the middle, we can check out the PE ratio of Apple, which is around 30 at the moment, with a maximum of 41. Now, what about Tesla? Let's check out Tesla's PE ratio. All right, guys, so we got some crazy numbers here, right? Was minimum 556 and a maximum of 1,410. Now, sometimes PE ratios also don't compute at all because sometimes companies are not profitable. For a while, Amazon or Tesla was not a profitable company, and so this PE ratio did not even make any sense because the earnings was actually negative per share. So when Kevin is trying to analyze the value of the actual company, he's trying to say how much they're going to make, how much they're going to earn and keep, the net income, and then he's going to multiply it by the PE ratio so he can get the price of the stock. Here he's keeping the PE ratio at around 100. So when his bull case is getting Tesla to 6,000, the PE ratio is at 100. PE ratios will eventually go down as Tesla makes more and more profits and starts realizing the massive potential, meaning they are actually starting to profit from it. The PE ratio will go down and down, which is okay because now it's becoming more of a value play because they're actually becoming more profitable. So with that number, that PE ratio changes everything, right? If the PE ratio was 200, then the stock price would be 12,000. If the PE ratio was 50, the stock price would be 3,000 based on his data. So how do you do all this stuff? How do you kind of understand the market well enough to invest, but not kind of get totally overwhelmed with the entire process and all of these numbers. Now, my strategy for investing in individual stocks, let's say Tesla, is what do I believe about the company that the overall public does not believe? And this is the biggest thing that drives the actual price of a stock. Because what a stock is priced based on the pessimists, the people who don't believe something is going to be worth more in the future, selling the stock. And the people who are optimistic, who believe it's going to be worth more in the future, are buying the stock. So all the price is that determines this price is what people think it'll be worth. What people think a company is worth is based on what they believe now. They're thinking about the future, but they're in the current mindset of what they know now. If they believe Tesla's going to be incredibly successful next year, and there's news about that right now, that they're going to be profiting a crazy amount in 2022, guess what the price will do? It'll go up today because they're realizing, okay, the future is going to go up, so I'm going to buy today. Right now, Tesla is still rated pretty poorly. It's rated a D on Charles Schwab. I bought Tesla when it was rated an F. And my gain loss here is at 300%. But in reality, when I started buying, the gain percent, it was around 16 to 1700%. It hit 2000% at one time. I bought it at a rating F. The rating F, I saw that Elon was getting tons of trash in the media. A lot of stuff was going in about how Teslas were terrible cars, and I actually drove one. This was years and years ago, and I realized, you know what, this is an amazing thing, and I think that this is the future. I learned as much as I could about the company. I got a little bit obsessed with it. I watched a lot of YouTube videos about the community. The Tesla community is really popular, and it was pretty crazy to see how, unlike any other car company, they have the incredibly strong branding and community. I was also at the same time realizing that Tesla had a huge short position, meaning a lot of people were betting against the stock, and that was affecting the media. I could see tons of articles on different news sites really out of proportion, hitting on all the negatives instead of focusing on the reality. So for example, Tesla would be rated poor for quality build and paneling of the windows and things like that. However, they'd also by the same company be rated #1 for customer satisfaction. And the articles and news sites would focus on the negative, on how they have terrible build quality. However, what I realized is they were disproportionately focusing on the negative, maybe because they had huge short positions, and this made me increase my conviction in the company. I felt there was an imbalance between the reality of the stock and the company and people's beliefs and understanding of what the company was doing and where the company was at. And so that made me dial in and believe in buying. So when you are looking at buying different companies, the biggest thing you need to kind of think about is that the price of the company, and if it is a good buy, is only based on this one thing. It's based on if people today don't understand the value of it tomorrow and in the future. If you think people are missing something, if you think people are disproportionately, meaning over negative or over positive, over what reality is, that's where opportunity is. I understood and realized that people did not get Tesla, they did not get Elon, they didn't get him as a person, they didn't understand what they were, that they weren't a car company, and that was a huge imbalance of reality and what I believed to be true compared to what other people believe to be true. And that's where the opportunity really lies. So as you look at crazy data, as you get kind of overwhelmed by all these graphs, and Meet Kevin is incredibly quantitative and all this data, I think he does an amazing job going through these numbers. I highly recommend you check out his channel. The biggest thing with a company is going to be, do you believe that expectations from other people and the market overall is higher or lower than what reality will actually deliver? And that is going to determine if you're buying a stock at a deal or you're overpaying. So what do I think about Tesla? Well, I've actually bought in as the market has been dropping. So In February 25th, I bought at $683 per share. I bought again at $619 per share. I bought again at $578 per share. And I bought again at $565 per share. Now, what I try to do when I'm buying in, by the way, is I try to buy more each time. So I bought 20 shares initially, 30 shares, and then the price kept going down, and I should have bought a little bit more, but then I got my diamond hands back, and I bought more shares than I have throughout this dip. That is something I try to do. It's hard to mentally do, where you buy in and then things dip, and to mentally buy in more than you already put in. But that is what I try to do in dips. I try to hold myself accountable to not letting my emotions get in place and just realize if I believed it was good at this price, I should get even more at the next price that's even lower. So those are my thoughts on Tesla, and Meet Kevin's video. And analyzing is great. Looking at the numbers is great. In the end, the PE ratio is going to change everything. And what I want to convey is that my perspective for investing and choosing a specific stock is going to be mostly, hey, what does Wall Street think? Meaning, what does the mass public and investors believe the stock is going? And if I believe something dramatically different than that, that is where there's massive opportunity. Always buy what you believe in, but what you also understand. And if you notice, my portfolio is what I actually use. So I use Amazon. I am filming this on an Apple device. I drive my Tesla, and that allows me to understand the company a bit more, understand how excited consumers are, and get a little bit more invested in the actual company. Let me know what you think about Tesla at today's price in the comments below. Please like this video for the algorithm. I really appreciate it, and I'll talk to you soon.